Hi, everyone. Thanks for tuning in for another episode of the Market Pulse. On the call today, you have myself, Bepin Serraj, as well as Mike Sorrentino, and let's talk tariffs. Obviously, that's been what's been driving the markets over the last few weeks, really since almost inauguration. It's been talk of tariffs and trade wars, and obviously, with that has come quite a bit of volatility, as you've probably seen if you've watched the news or been on the internet over the last few weeks. As always, we got some disclosures. And our favorite, the quote of the week. This week, we're going with the stock market is the only place things go on sale, and everyone runs out of the store screaming. We couldn't find who to credit this one to. There's been various usages of this. We've used it numerous times before ourselves. It's just a classic reminder that when things go on sale in the market, it's not always, I know it hurts that you're losing money from the things you're already holding, but it's a great time to be redeploying and adding more to equities, buying the dip. And that's where we start off with, obviously, the VIX, as you're seeing there in the blue line. This is just showing the S&P 500 and the NASDAQ 100 since the beginning of the year, as well as the VIX index, which is the volatility index, just showing changes. That's all it's really measuring is change. And as you can see, it has skyrocketed. On the announcement of the tariffs, it has jumped up to almost 50%. But let's not forget that volatility is mean reverting both ways. So one of our favorite quotes, or one of the adages that we use, is when volatility is low, look out below, because you'd expect volatility to rise if it's sitting low. And when volatility is high, it's time to buy. So that's what we're pointing at here, that volatility in itself creates opportunity. And why has it been so volatile? Like I said, the trade wars are heating up. The tariffs caught everyone kind of by surprise. I know a lot of it was talked about at first. These are just negotiation tactics. We don't expect them to ever come on. Then they came on. So that caused a little bit of panic. Geopolitical concerns aren't helping, obviously, with the Ukraine debacle that we saw with the Oval Office, and especially with the Israel-Hamas war. The geopolitics definitely are not helping. And traders obviously are always still worried about inflation and Fed error. Is the Fed going to mess this all up? Another reason, it's really easy to sell when everything's trading at all-time highs. The chart over to your right here is showing how many companies have outperformed the S&P 500 within the S&P 500. And when the bar is low there, that shows really really concentrated market. What we've been talking about over the last couple of years with the Magnificent Seven, driving majority of gains. And as you see here, only 29% of S&P 500 companies outperformed the index last year. So we're really seeing gains driven by a select few group. And when times get rough, it's very easy to it's very easy to just hit the sell button, obviously, especially if you're up. And another thing, obviously, with I don't know how much you guys are following in terms of Congress, but there's been the budget the budget that's being proposed right now, and as you can tell, the deficit isn't shrinking with that new budget proposal. So that's still a concern. That's still there. That runaway spending by the government leads to more inflation, and here we are. That's really the concern, is that runaway inflation takes over and causes more
Yeah, I
pain.
think that what you said was interesting there. Is that the concerns, fears, panic,
Yep.
and whatnot. Look, in that
The
list that
fear
you
du
put up,
jour. Yep.
yeah, there's some legitimate concerns on that list, like the deficit, things of that nature. But there's always
Hmm.
something to worry about. I think
Exactly. Yeah.
what I find to be interesting about a lot of what we're seeing right now is I actually don't really see much fundamental changes in the fundamentals, right? I
Yep.
think what you're seeing here is volatility is like a compressed spring, right? I love your adage, that rhymed, but it really is a compressed spring. The
Yeah.
further down it goes, the more violent you see the reaction, right? Think
Yep.
about like I love the comment you brought up about the Fed making a policy mistake. It's not
Hmm.
necessarily that people are worried about inflation and a couple of goods that are going to have tariffs on it. I think what it is there's a misinterpretation of that data by the Fed. And we all
Yep.
know the Fed has a long history of misinterpreting stuff. But
Hmm.
ultimately, a lot of this is just emotionally driven.
And what Mike's getting at with the misinterpreting is that they see that the tariffs are going to lead to inflation, so they don't cut rates, and holding rates high for too long could lead to something breaking. So that's what we're really getting at there with the Fed error, is that they hold rates too high for too long. And keep in mind that volatility is a feature of the market, not a bug. And obviously, this the bar, actually, a little joke between me and Mike here, is this red box has had to move over from the original.
Oh
We
yeah.
originally had it at that 3% dip, and obviously, you watch a couple more days in the market, and here we are. We're sub 5 now from the chart a couple slides ago, where we were looking at the Nasdaq and the S&P 500 year to date. But this is completely normal. In an average year, you would expect 3.5 of these type of corrections. Even if we get to 10%, you should expect one of those a year. And another thing to even keep in mind is look over to the right there. The 15% severe correction happens every 2 years. Do you remember a 15% correction last year, Mike?
Nope.
Me neither. So that's still on the table as well. And that wouldn't be something that should cause massive panic. These are just law of averages here. We'd expect one. And let's focus on the difference between this year, which this isn't just an average year. This year, we have a new administration, a new president. And what does that look like on average in history when a new admin gets in there? You see a lot of chop. You see a lot of volatility, as you see highlighted here in the yellow. That's the average return between January and May. And on average, it's only positive 55% of the time. And guess what the return is on average? 0.1%. A choppy start isn't abnormal, so let's not panic here.
Yeah, Bepin, I'm going to jump in on this one too, because I mean, look, you and I both see this the same way. Like, we don't believe in investing based on
Yeah,
calendars,
exactly.
right?
Yep.
But you got to think about, like, that yellow shaded area. I think is interesting. Why is this happening?
Oh.
And it's hard to know for certain, but I do think that the big reason for this has to do with what you just said, the new administration coming in. Any new president, Republican or Democrat, is going to have an agenda that they campaign on, and they're going to have to show immediate moves. And so there's a lot of uncertainty that kind of unfolds as that new presidential administration gets settled in the White House. Now, one thing that I've learned in my career is that the markets will take a bad economic policy that is predictable any day of the week and twice on Sunday versus an unpredictable policy that might be better. All right. That sounds crazy, but the predictability nature allows investors and traders to understand the rules of the game, and they can figure out a way to make money. When it's unpredictable, the goalposts keep moving, and it's a very, very difficult time to know what to do next.
We love certainty in finance, though we never get it.
Yeah, speaking of certainty and uncertainty, I guess I took the short straw this week, and I got to talk about
You seem to always draw the short straw.
I do. I don't really have a lot of luck.
That's straws, Mike.
That's why I don't play credit card roulette when I go out to dinner with my friends. So that being said, look, tariffs, it's a big thing in the media right now. But let's be honest, like, tariffs have been around since the dawn of time. They really have been. Some economies have been built on tariffs. And fast forward to today, pretty much every developed country out there tariffs each other's. Yeah. It's widespread. And I'll give you an example here. Canada, this is going back years. Canada has imposed tariffs on the U.S. goods. Look at these numbers: milk at 270%, butter at 300% almost. You might be sitting there saying, "Oh, well, now I kind of see why Trump's doing what he's doing," and we're not defending anything. We're just saying, like, these have been out there. And ultimately, the problem, though, is you can't take tariffs for face value. You look at these numbers, and you automatically want to get mad at Canada, but you got to understand, most of these tariffs are based off of quotas. So after you hit a certain quota, then the tariff kicks in. So you can't just look at these numbers that you're seeing in the media or really anywhere and say, hey, these tariffs are blanketed. There are so many nuances and exceptions to every single tariff out there that it's virtually impossible to really know what the economic impact could be going forward. And I think what's interesting here, this is where we could debate a little bit, is that look, the academics are going to tell us what tariffs are. You know, they're deadweight laws. They're inefficient, right? Yep. And if a country could do something better than ours, they should be able to do it, and this and that. But there are some adverse effects, and ultimately, if you look at the trade deals between the United States and other of our trading partners, they're not good. I mean, and this is not me defending Trump. Far from it. What I'm saying is, from an economic standpoint, they don't make a lot of sense. So there might be non-economic reasons why we don't fix them, and I don't want to get into those politics. But from a straight numbers perspective, there are massive dislocations. So ultimately, we got to ask ourselves from our first principles approach, if these do move forward, they're changing every day, but if they move forward, what could be the potential impact on the US and other countries? So that's what we're going to try to do from a first principles approach. And to do that, the first thing we have to look at are exports. Okay. Some countries export more goods than others. So if you look at the bottom of this chart, as you'll see, the United States is there at 11%. Okay. So 11% of our GDP effectively is just exporting stuff to other countries. And for all intents and purposes, it's not a huge portion of our economy. It just isn't. Does it matter? Absolutely. We'd like to see it go up. Yes, but we at the same time, we don't necessarily want to change the overall composition of our economy because frankly, it's pretty good. It's based on services.
Yep. And services are the higher margin.
Much higher margin.
You can be
much less risk in terms of commodity input prices and all the stuff that impacts these other countries more heavily. For example, if you go up just one to Canada on this list, just above the United States, Canada, as you can see, has a much larger portion of their economy that is export driven. They're very heavy in minerals and natural resources, things of that nature. So they export a lot of their goods. So in terms of impact on an economy, tariffs are going to impact Canada way more than the United States. Then you go to Mexico, and then this is when the number gets really big. You know, over 40% of Mexico's entire economy is just exporting stuff out across its borders. All right. Now China, I mean, look, China's, you know, they're kind of the, you know, the goat or whatever you want to call it.
I think that number would surprise most people. I think most people would think of China as being pure exports only.
Yeah, that actually it tends to shock people. But yeah, China's somewhere in the middle. You know, do exports matter to their economy? Absolutely. They're one of the largest, not the largest economy in the world right now. But ultimately, the U.S., we're just kind of a unique situation. We just don't export that much relative to other countries. So then the next step of this is, okay, well, let's say right now, obviously the three countries that are in the news the most, Canada, Mexico, and China, what percentage of their exports comes to the United States? Because then we'll have a better understanding of what these tariffs, or if we get into a tariff war or a trade war, whatever you want to call it, what that's going to do.
You can basically take a look at each player's hand, so to speak.
Exactly, right? And if you look at Canada and Mexico, and this is why I think why Trump's doing what he's doing, is that Canada and Mexico, you talk about 80%, or roughly speaking, of both of their countries' exports come into the United States. 80-something percent. We are a really, really, really important customer. We're kind of like the Costco in consumer retail. Costco tends to be the largest buyer for most retailers that actually do business with them, like by far. So it's going to be really, really tough for them to complain and fight us because we do have a lot of leverage on them. China, if you look in the lower left-hand corner, not so much. Again, very surprising, I think, Bepin. I think most people think that we're huge for. We're important to China. Don't get me wrong, but
you got to keep in mind they're a huge economy. So if we're 30% or if we're 10-15% of that, that's a huge dollar amount.
Huge dollar amount. But ultimately, you know, if we get in a little fight with, well, look, we've had tariffs on China for years now, and you know they're still paying their bills somehow. So you know, ultimately, a little bit of less impact on China. So let's add it all up. Whether you like Trump's policies or not, you got to push that aside. The numbers are showing clearly Trump has massive leverage, or the U.S. rather has massive leverage on Canada and Mexico. We just do. If you want to actually add up the exports and then how much is exported directly to the U.S., the impact on these economies is not even close. 19% of Canada's economy is nothing more than sending goods to us. 19%. That is a huge, huge number. But it's actually smaller than Mexico. Believe it or not, Mexico is close to 40%. 37% of their economy is just sending us stuff. 37%. That's a massive number. Now compare that to the United States. The US, if you combine Canada and Mexico together, because you got to do that together, combine both of them, they're only 2.7% of the US economy. There's no comparison. It's not even close. Okay, so when I talk about leverage, this isn't us like bragging or like high-fiving Trump or anything. This is just pure math. Okay.
Hmm.
This is where that leverage is coming from. All right. And I like to say that tariffs are not bound by the laws of gravity. Okay. These are tools that the academic community and a lot of media is saying are terrible. And I'm not necessarily taking the other side of that argument. What I'm saying is that tariffs are not bound by physical laws. Okay. A lot of times things that happen in finance make absolutely no sense. Do you remember zero interest rates? Do you remember when
Hmm.
oil went negative in 2020? There's a lot of weird things that can happen in this world that the academic textbooks cannot explain. So my point here is that I would not come and look at the tariff situation and just say automatically that they are bad and they shouldn't happen. A lot of times there are other reasons to use them, and we're seeing why Trump's using them right now. I would also say that there's a lot of concern about tariffs causing inflation. We've kind of addressed this a little bit in the past. I want to be very
Hmm.
clear. Tariffs will cause the prices of some goods to go up. They just
Yep.
will. But will that ignite widespread inflation? That's
No.
very difficult to do without doing some massive increase to the money supply. That is where the widespread inflation is going to come from. So I'm not
Hmm.
worried about inflation. But going back to what we talked about earlier, Bepin, I was like, I think
Hmm.
the concern here is that it becomes a misread or a misunderstanding by the Fed. Now,
Yep.
the Fed misreads this. That's where I think the risk is. But I think the risk right now is very, very small of that happening. So
Yep.
ultimately, we've seen it. We've seen it all year. Well, since Trump got in office.
Yeah.
My strong opinion here is tariffs are being used as negotiating tools. Yes, there's some money to be made on tariffs. I don't think the tariffs on China are going to go away, but for all intents and purposes, they're not going to pay down our debt. There are other ways they're going to happen. So,
I, I was just going to add about the negotiating tools part. I think that might be kind of the theory behind why the tariffs did go into place, is that everyone kind of knew that, or at least assumed they were negotiating tools and that they'd never go in place. And if you want them to believe that you're really carrying a stick, they need to see it. So that could be another reason.
yeah, look, I mean, I think well, it goes back to this fifth point here. I mean, we've been talking
Hmm.
about short-term pain for long-term gain for a while, and then Trump actually used that last week in
Yeah.
his interview with Maria Bartiromo. I mean,
Yep.
ultimately, he's like, look, the way he's talking, Bepin, I think it ties into
Hmm.
exactly what you just said.
Yeah.
He's going out there and publicly saying these things as to kind of remind people when they sit down at the negotiating table with him, he is willing to
Yep.
put our country through a little bit of pain to get a long-term gain out of it. And that has got to scare the heck out of anybody that's willing to negotiate with Donald Trump right now. Because think about the long game. I mean, I think we're getting flooded with headlines and media coverage about tariffs and some of the near-term concerns. What I think is
Hmm.
getting lost are some other headlines. So if you look at some of these other headlines that are hitting that have come out just over the past 2 weeks, Saudi Arabia is going to invest 600 billion over 4 years. SoftBank another 100 billion, which I think they might actually increase that. You're talking about Honda. Honda had huge news last week. They're no longer going to be making the next Civic in Mexico. They're moving the whole thing to Indiana. So are these near-term things? Not really. Are the numbers
Yeah.
going to be exact? Probably not. But ultimately, think about, you're talking about trillions and trillions of dollars
Yeah.
being of manufacturing and economic activity pushed into the United States. That's new tax revenue. That's new jobs.
Yep.
Think about the strength of the economy. We mentioned earlier. You think about manufacturing in the United States, 11% of our economy. If we can move that to just 15%, all
Hmm.
right, not a structural shift in our economy. Just think about what that could do for the long-term strength of the U.S. economy. So
And
again, we don't want to sound like we're like getting political here, but
mhm.
there are some objective advantages for investors, especially if you think over the long run. And I think
Yep.
about where we're trying to position our portfolios. The duration of our thinking is aligning very nicely with some of these headlines you're seeing on the screen here.
I just quick math here. Like Mike said, these are real numbers. It doesn't matter what side of the aisle you're on. That's $2 trillion worth of investment on your screen. Doesn't matter what you think about who announced it or what they did about it. That's $2 trillion coming to the U.S. to
In
primarily
a
for
matter of a few
manufacturing.
weeks.
Exactly.
Few weeks.
So,
Think about
and
what's
then
going to happen in the next couple of years.
exactly that's the hope. And now, obviously, now Mike's focusing on the short or on the long term there. Most of the people listening here are probably a little bit more concerned about the short term. So what you're looking at here is the S&P 500 in 2018. One thing some people might have forgotten is that we've been there and done that with these tariffs, or at least a form of these tariffs, which will be in 2018 with the Chinese tariffs. So what you're looking at here is the S&P 500 throughout that year. In red on your screen here, you're looking at the tariff panic. The first part was when they were first announced, and then when they went into place, and then we saw the Chinese react. Um, and what you're really looking at here is it took the market maybe a couple months before it realized that these are one-time events that you go back to business right after. And this is what we kind of expect with these ones as well. Obviously, they're a lot different. This particularly like the Mexico and Canada ones, but we've seen tariffs in the past. And like Mike said, we do believe that these are negotiating tools, and we don't believe that they would be permanent. And then another reason that we've been pounding the table over the last year in terms of our positioning. I mean, if you recall, some of the things that we've been mentioning is we've been adding bonds to the portfolio. We've been adding value over growth. We've been adding international stocks as well as emerging markets. We've been adding Chinese equities. And if you look at performances on the year this year, those are acting as ballast to our portfolios. And that's one of the reasons why we always insist on being diversified. You never know where the bull case will come from on some of your holdings, but that's why we are always properly allocated. We never give up on asset classes just because we've seen one asset class do the best for a certain amount of years. You got to stay diversified, and that will help us get through any of this turmoil that we could see over the next few months. Is just remember that we do hold things outside of just the S&P 500. And obviously, if you have any concerns, we understand this is a very volatile time. We're always here for you. Feel free to reach out via email, call, any way you can get a hold of us. We'll be there for you. Thanks for tuning in. Have a great weekend.